You've just hit withdraw on your crypto exchange, and suddenly you're stopped in your tracks. The interface demands you choose a network from a drop-down menu, and you're staring at options like ERC20 and TRC20. Make the wrong choice here, and your funds vanish into the ether. Make the inefficient choice, and you'll bleed capital on unnecessary fees every time you move money. These two network standards process billions in daily volume. They are the heavyweights powering the vast majority of stablecoin transfers, particularly for assets like USDT. This chart maps the exact trade-off you are forced to make. On the axes, we have transaction speed and ecosystem size. As you can see, ERC20 sits high on ecosystem integration, but low on speed, while TRC20 flips that dynamic completely. We aren't looking for an absolute winner between the two. The goal is to break down how these networks are built and match their specific traits to your immediate objective, whether that's funding a trading account, yielding in DeFi, or holding institutional capital. Treating all blockchain networks as identical utility pipes is a costly error. The digital asset you hold behaves exactly according to the track it runs on. To understand those tracks, we need to define what a token standard actually is. Think of it as a strict technical rulebook. It dictates exactly how a digital asset moves, validates, and operates on its specific host blockchain. ERC20 is the veteran in this space. Ethereum launched it in 2015, establishing the blueprint for programmable, smart contract-based assets. 3 years later, the Tron network launched TRC20. They built their rulebook explicitly to maximize transaction throughput and raw speed. This creates a unique situation. The exact same stablecoin, USDT for example, exists on both networks simultaneously. But an ERC20 USDT and a TRC20 USDT obeyed two entirely different sets of host rules. Because these underlying frameworks dictate how transactions are verified and prioritized, the network you select dictates the time it takes to settle and the fee required to execute the transfer. Let's look at the engines powering these standards. Ethereum operates on a proof-of-stake model, distributed across more than 1 million independent validators globally. This massive scale provides extreme resilience. To overpower these distributed nodes is nearly impossible, which is why institutions trust it. But coordinating over 1 million validators creates operational latency. Data packets move slowly through this dense web to achieve consensus. That friction results in block creation times of about 12 seconds, capping Ethereum's base processing power at roughly 15 to 45 transactions per second. Tron tackles validation differently, relying on a delegated model with a highly concentrated group of just 27 super representatives. Stripping away the massive global network removes latency. With only 27 nodes, Tron produces blocks every 3 seconds, clearing over 2,000 transactions per second. The cost of this velocity is structural trust. You sacrifice broad decentralization by relying on a small, centralized group to maintain the ledger. Ethereum's massive scale guarantees trust through distribution, while Tron guarantees speed through extreme centralization. Those architectural choices hit your wallet directly. On Ethereum, users must actively bid against each other for limited block space using a gas fee model. This chart tracks transfer costs over time, and it highlights the unpredictability of that bidding system. The Ethereum line might average $1 to $3, but during DeFi protocol launches or network congestion, costs spike aggressively upward, frequently pushing past $15. During these traffic jams, validators prioritize users willing to pay the highest premiums, leaving smaller transfers stuck. But Tron takes a different approach. Instead of the bidding war, Tron uses fixed energy credits and bandwidth points to process data. This mathematically stabilizes your fees. Regardless of how busy the Tron network gets, a standard transfer rarely exceeds 50 cents and often settles for a fraction of a penny. If you are sending $50 to fund a retail account, paying a $15 variable network fee on Ethereum destroys nearly a third of your capital before you've even entered a trade. Unpredictable high fees act as a silent tax on trading margins. For high-frequency, smaller transfers, Tron offers the fixed structure necessary to protect your capital. Where Ethereum justifies its premium is in utility. Its network hosts over 3,200 decentralized applications, establishing absolute dominance in ecosystem integration. This infrastructure powers complex financial actions. It is the native environment for yield farming, large-scale liquidity pools, and automated trading bots on platforms like Uniswap. If you hold an ERC20 token, you have frictionless, immediate access to this entire interconnected web of financial strategies. Tron's native ecosystem is significantly smaller. With roughly 400 dApps, it is optimized primarily for fast, single-layer tasks rather than complex multi-protocol interactions. Taking a TRC20 asset into the broader DeFi landscape introduces friction. You have to route your funds through centralized exchanges or rely on third-party cross-chain bridges, which introduces counterparty risk. Ethereum operates as a comprehensive, fully interconnected financial universe. Tron functions primarily as a highly efficient transport rail. As this decision tree outlines, the most practical way to navigate this is to stop looking for an objectively superior network and start matching the protocol to your specific financial job. Consider the active trader. You want to quickly fund a brokerage account like FXNX to trade Forex or send a fast cross-border remittance. Your choice is TRC20. The 3-second settlement times and sub-penny fees provide instant market access without eating into margins. Next, consider the DeFi participant. You are looking to lock up capital in liquidity pools or execute cross-protocol arbitrage. Your choice is ERC20. You pay the network's gas premium to gain native access to the deep liquidity and established infrastructure of decentralized finance. Finally, consider the institutional holder, managing massive 6- to 7-figure sums of capital for long-term storage or transfer. You also want ERC20. When moving millions, a $15 network fee is irrelevant. The priority is the security provided by 1 million independent nodes verifying your ledger. Aligning your operational goal with the correct architecture eliminates friction. Guessing introduces avoidable risks and wasted capital. Think of Ethereum as a highly secure, high-yield vault, and Tron as your high-speed, low-cost transport vehicle. Whichever you choose, always double-check your network drop-down menu and match it to your destination address before you finalize a stablecoin withdrawal. Consistently paying high fees for small transfers or trapping capital on isolated networks are small operational errors that compound over time, dragging down your portfolio performance. Understanding the technical nuances beneath your assets is the critical first step to executing a professional,